What do we know about the future? And how do we trade it if we do know something about the future? We're going to talk a little bit about that and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We apologize for last Wednesday when we were unable to do the stream. The crack production staff that it makes this whole thing go. Unfortunately, we're experiencing some issues on the East Coast. I'm 3,000 miles away. It was nothing I could fix from here. So unfortunately, we missed it. But we're here today. So for those of you, and I know there were a couple who had logged on for that, I apologize. And I saw that actually a few of you were even logged on for a little while. Finn West, welcome back. Yes, indeed, we're giving it another try. It wasn't a connection issue. It was literally the thing being turned on remotely. There was a little bit of an incident on the East Coast. People will say, oh, you know, actually I think of John Belushi when he's making excuses to his former fiance, Carrie Fisher, in the cave at the end of the Blues Brothers, basically. And he says that there was an earthquake, a terrible flood. He had a flat tire and all this other kind of stuff. In fact, there was some car trouble on the East Coast. There was a well, I don't know about a fire. There was some kind of an electrical issue and smoke coming from underneath the hood is my understanding. So definitely something that had to be taken care of. So let's just talk a little bit about the future first, though. And I've got my screen up here. And I'm going to just let everybody take a look at this chart for a second and see if they notice anything interesting. So this is a chart of the S&P E-mini futures. This particular time series chart is a snapshot of what took place between 1 in the morning East Coast time and 7 o'clock in the morning East Coast time today. And if you look at the bottom part, this is volume, you'll notice that there was quite a big spike right here, just about 10 minutes before 7 o'clock. More than 4,000 futures trade. There's actually some other bars right around that. I think about 20,000 contracts or so traded between 6:45 and a little after 7. And we know that those were bought. How can we tell? Well, if we take a look at the price chart, we can see that the price was trending pretty much, oops. What did I just do there? That's not what I wanted. The price was trending down, and then all of a sudden it spiked right around the same time that we got that volume spike. That was right here. Oh, I see what's going on. I don't have my annotation tool, so we're just going to be dealing with my cursor today. I'm not sure what happened there. But if you're looking where my cursor is, you can see that the future spiked a little bit on that big volume. And we can also see that this proved to be quite a timely purchase because right about where this little block is, that's what I'm trying to point out. So right here, there was a decent bit of volume. All took place around 65:18-ish or so. And then, of course, you can see that we had up here, where this annotation is, we had a big spike. So that was right after the president sent out a Truth Social post. Now, I actually signed up for a Truth Social account because I think it makes sense to see what's coming out of Washington. That's the good news. The bad news is I rarely remember to log into it. I was not logged in this morning, and I was on the desk. We have a trading call that takes place early in the morning, so I was on that. But yeah, the market took off, and we saw some unusual futures activity that took place there. That's not the only place that we saw it. We saw it here too. So again, just look for since you're not seeing my annotation tool, but you can see a little blue box pop up, little label down here, right there. So where that blue box, you can see that there's a spike before there's another big spike. And that was a sale. That was a sale of the futures, and we can tell that here too because we can see that the futures sold off, rebounded after that big volume, and then sold off hard. So, was this trader just lucky? Lucky enough to realize that crude was about to fall $10 a barrel, and that the futures were about to rally 100 points? Don't know. It's fortuitous to say the least. And that's 2,000 contracts, so that is going to be 2,000 times 1,000 times 10. So that's 20 million bucks. And over here, this also turned out to be a like amount, right? Because it was at least one block of 4,000, 4,000 contracts times 50 gets us to 200,000 times 100 is another 20 million. So that trader, if it was the same trader, but both trades were placed at almost identical times, that was a quick $40 million. And when I say quick, I mean really quick. We're talking about from 10 of until 4 minutes after. So not bad for 15 minutes work, I have to say. Pretty interesting. Anyway, just thought I would mention that the reason we might be interested in something like this, you can get a Truth Social account, and you can wait for impactful tweets, and you can monitor whatever happens to be trading, particularly if it's before the open or after the close. And the two principal places where folks are likely going to do something like that would be it would have to be in a market that was liquid enough to trade. And futures are typically a good place for that. And the E-mini futures trade quite actively. As you can see, they've already traded over 2 million contracts today. And they did trade around 21,500 contracts, I think, between 6:30 and 7:05 or so. So, but if you're, watching the tape, a lot of people will. I will watch the E-mini futures just to sort of see where the market is pre-open. I'm usually just monitoring the price, but I think I will keep a closer eye on those types of block trades. Alex is asking, I wonder if the SEC will pay any attention to those spike trades. So this is interesting. When I was making markets, there were definitely circumstances that we would see trades that were highly unusual immediately followed by some really impactful event. We were trading principally single stock, but we would see what, at least to us, appeared to be footprints in the snow, if you will, that suggested that maybe somebody had some information that not everybody else was privy to, and were trading on that information. The way we would handle that is we would typically report it. As far as I know, from all of the times that we did report it, and you need to remember that we were trading, for years, we were trading hundreds of stocks every day, lots of traders, and millions of contracts, probably hundreds of thousands of trades. So we did report these things. As far as I'm aware, it all came for naught. I don't ever remember being told, oh yes, we've investigated this and we found out that indeed somebody did have access to information they should not have, and they traded on that information. Now, the other part of this is that, in theory, if someone did do that, we were clearly the victims of it, right? Because they were just lifting money out of our pocket and putting it into their own. In theory, if something was found, then I would assume that we would have been offered some recompense. But actually, I'm not 100% sure, to be honest, that that's how that works. I know that people get fined. I know that they have to disgorge profits that they were not entitled to. But do they necessarily return it to the counterparties, or does that just go into the government coffer? The truth is, I don't know. What I do know is that we complained loudly when these types of things took place, but it never seemed to end up in us being compensated for it. The next question is, what is the, does this qualify as the same kind of thing? I'm not 100% sure, because in the case of the S&P, generally speaking, what are we talking about when we think about people trading on, quote, inside information? What you're usually thinking about is somebody knows about a regulatory change before it takes place. So, when we think about Congress trading on inside information, regulatory changes that could impact industries either for the good or for the ill, and trading on that information. Or people who have access to intelligence because they're on the board or they know somebody who is, so they know of an impending corporate action, takeovers, things like that. Accountants, lawyers, that's a commonplace. So one of the places that it was really common to see some of the bigger insider trading scandals back in the 80s, for example, was that investment bankers knew about a deal and they would tip somebody off. Raj Ratnam, I'm trying to remember what the name of his hedge fund was, but they were always scraping around the street looking for information. But if you know of something geopolitical in nature sooner than somebody else, obviously there's a victim. Whoever was on the other side of that trade was not happy about having taken that. But I don't know exactly how that gets treated. But I can tell you that it's on a couple people's radar because it was unusual. It was a lot of volume, and you look at that chart and you can see for yourself that these things were remarkably well timed. I thought I would just bring that up because it's kind of a reminder that we sometimes do care about unusual volume or price action, because this is exactly what you're looking for. Now, here's the thing. If you were doing that and you saw that big print, you actually could have bought the futures at a lower price than they did if you were trading in smaller size, because the price spiked when they bought them and then immediately fell. And the same thing happened with the crude contracts. They dipped, then they bounced back, and then, of course, they just completely fell out of bed when the news became known. So, if you are simply trading the tape, that's not inside information. It's also no guarantee that something important is going to happen. But if you're looking for, again, the footprints in the snow, this one shouldn't be difficult for somebody who's really curious to try to get back to what was going on there. Just thought it was interesting, and I would bring it to everybody's attention. Okay, so what is our next question here? Hi, Mike. I fell into some IPO shares on VCX, Victor Charlie X-Ray, which listed last week. It's 10x since. Congratulations. That's nice. When options start to trade, how best to protect the gain through the lockup into September? Long puts, short calls. So, one of the things that typically happens when options first list on something that IPOs is that the implied volatility will typically start out quite high, and then it will drop pretty consistently. I did a study of all of the IPOs from the late 90s up until just before Facebook's IPO, and it was because I was researching volatility behavior for Facebook's IPO. So my suggestion would be probably something like collars, like a zero-cost collar, or maybe a put spread collar, because the options premium is going to be very high when the options first start trading. And people will often ask, they'll say, well, when will the options start trading? It used to be that they would wait quite a while after an IPO for that to happen. What they have to do, actually, is they have to ensure that there's a minimum number of shareholders and sufficient trading volume. That usually takes a few days to weeks to establish, depending on the underlying security, and then they'll list. So I don't know exactly when that's going to happen, but I would expect that, especially given the price action that you've seen since the IPO, I would expect that the options premiums are going to be pretty elevated, and therefore you're going to want to do some kind of a spread strategy on that, is my guess. Okay. Youth is wasted on the young says, I've successfully used the stock repair strategy a number of times, buying one at the money long call and selling 2 short calls halfway between the market and my cost. Are there strategies similar to this one might pursue from the jump, not just to bail out a bad trade? I've made some nice money on volatile names, putting on and taking off such ratios. So I'm assuming what you're referring to is, can you use ratio put spreads instead of ratio call spreads? And the short version is that, yeah, of course you can. And actually, that's not a bad idea. We have often, let's see. Let's do this. We used to see a lot of this. I haven't seen as much of it discussed lately, but this was something that was very frequently something that was discussed at an institutional level. There was an options trading group that moved from a couple different firms. I won't bother to mention the names of the people that were involved, but I will say that the guy who ran that group was named Michael, not me, but somebody else, and people who are well-versed in sort of the big agency institutional options desks and strategists of, the late aughts and early teens will probably know who it is I'm talking about. I don't know if that person is still in the business. I'm actually kind of curious. I'll pull it up on another screen here. Let's see. I don't. Let's see here. Yep. Well, so I'm being told if you're not going to share his name, the real issue was whether I was going to share his name depended a little bit on whether he's still in the business or not. I'm not here's somebody with that same name who works at a place that could be, so I'm going to leave that alone. But what they would do is they would very frequently get long puts and then sell some puts with an eye towards dynamically trading the short put side against the long put side. Let's work through an example. I don't even know that it matters. We could choose Apple since we're here already, and I will just go out to the monthlies. So they might do something as follows. They might say buy a 35 delta put, something like that. So we'll just add that in. I'm going to put this into a combined payoff so we can sort of see what that looks like. So you have this situation going on, and maybe they would buy more than one of those. So we'll just call it, for now, we'll start it at 2. All right, so you'd have this oftentimes as a hedge against a long position. And then they might sell one of a lower strike option against it. All right, so maybe I'll just use the 232.5s or something like that as an example. So then they would have a trade that looks like this: long 1, short 2. Now, if the underlying fell, they would start increasing the number that they were short. So then all of a sudden they might go to a situation where they might be short 2 instead. So now they're in a put spread. And if it fell even further, they might actually get to a point where they would go up to a potential ratio and end up with something that looked like that. So there would be some lower level at which they would be willing to get longer, more stock. And usually they would do this dynamically. So as the stock fell, then they would start increasing the short side until they, especially if it fell back, down to that strike or maybe even slightly through it. So now you're essentially into an additional buy rate kind of a thing. So we would see that. And I do think that that's a decent play. Look, the objective here is really that if you have a view that you that you want to capitalize on a modest downside move, or even a fairly high one if it's a high volatility stock. Apple's not particularly high volatility. In fact, actually, that's a good point. I should probably choose. Let me think of what I was just looking at something recently that was relatively high vol. Maybe how about this? See how high volatility SanDisk is for the sake of argument. Might be a better example. So, yeah, this is probably a better example. High volatility, really. Now, why is that not? Okay, it's not populating the ticker, but you know what stock it is we're talking about. So here again, I'm just going to do the same thing. Maybe I'll go out to May 1st weekly this time. High volatility. So you might do something like, buy one. We'll go down. Now this thing has had such a huge move. Maybe we'll buy one of these. And now we're going to look to sell two. And we want to sell two on something that's approximately, how about these? There we are. So now you can kind of see where that sweet spot is. And you can also see where this lower break even is. Lower break even in this case, because we're looking at the 650, 565 for just about even money, which means that it's going to break even at $85 below 565. So 480. 480 is this downside break even from 702. I realize that when you look at this chart, you might say to yourself, well, do I really want to do this situation where I just sort of profit in here and then get net long here? I mean, the reason that just seems so wild is simply because of the huge move that the stock has had. Something that if you shorten up the chart and say, okay, well, I'm only going to look back at the last 3 months, suddenly it doesn't seem quite so wild, because you can see that that's actually, this downside break even is below the lows from earlier this month. It is below the lows from February as well. In fact, you have to go back to early January before you see that SanDisk was actually trading in that ratio. But the short version is, yes, you can do that. And if you've had, it's something. Here's another thing to think about, right? So if you were long the stock, let's say you were long SanDisk, and you profited, and now you're thinking, wow, this thing is really, it's come a long way, and I'm getting a little anxious. I think it could pull back. Well, if you sell your stock and you put on this 1x2 put spread instead, the worst thing that happens is you get net long down around 480 again, right? Stock's 702. So, another way of saying that the worst thing that could happen is you get net long the stock down $225 or whatever, right? Not a terrible way to do it. You're kind of capitalizing on a combination of the very high options premium. And that's one of the things, right? So ratio spreads will make sense when you think the options premiums are really elevated, as they are here. They're, like 80, 90% implied volatility. So you're trying to capitalize on that, and you're trying to capitalize on levels. And once you do those things, yeah, then sure, it's definitely a fair thing to consider. Okay. Producer says, it wasn't Mike's connection last Wednesday, it was me, the crack production crew. Yes. Some things happen at open interest. Yes, that is true. Okay. So, Alex, you're saying, ran a few backtest simulations, short 20 delta, SPY 30 day to expiration strangles versus buying the same strangles. Shorting them underperformed SPY, 10 in 3 years. Surprised that longs perform better than long SPY. Short 20 delta SPY, 30 DTE strangles versus buying the same strangles. So I'm curious. So When you say you back tested that strategy, number one, how often did you roll that position? And so if we look at 20 delta strangles, let's just say for the sake of argument, kind of along the lines that the Tasty guys typically advocated for. They like selling 45 days and covering at 21 days. Now you're selling 30 days. Did you just sell 30 days and ride them all the way to expiration? Because if you did, as expiration approached, I'm assuming you found and that you had a lot of short gamma and probably very little theta at the tail end of all of that. So how did you manage these positions? And did you evaluate this? So there's a couple different ways you can do analysis of this kind. One way would be, I'm going to sell 30 delta strangle. 30 day to expiration, 20 delta strangle. So selling at 20. Let's actually just pull this in. Let's just work through an example together. Okay. So one way you could do this is you can, as a part of your back test, you could say, okay, I'm going to pick some moment in time. December 31st, 2022, for the sake of argument. So that was assuming you did this test for. Well, you did 10 and 3 years, it looks like. Okay, but let's just assume that this is what you're doing. Okay, so you would take a 30 day to expiration option, and today we're on the 23rd, so we're looking for something around here, April 24th. There you go. And you're looking to sell a 20 delta strangle, so we will sell a 20 delta put. That is going to be these ones right here, and we will sell a 20 delta call. And that's going to be right over here. And that's so you're going to be in a position like this. Okay. So first things first. If you just do this and you do not delta hedge, and as I've discussed before, one of the things that I like to do as a hedge is to buy strangles and delta hedge, SPX. So kind of the inverse of this as my hedging strategy. But in this scenario, there's a couple things that you could do. One is that you can say, all right, well, if I am only going to just sell this thing and ride it all the way to expiration, then what's going to matter is how much premium I'm collecting. In this case, it's 8, 9, oops. My apologies. So you're looking at a little over $9, right? So what are we looking at exactly here? So we're getting a total credit of $9.43 over $6.55, spot 41. So 1.44% of the current level of the underlying. And your break-evens are going to be your long strike plus that premium. So 694 plus 943. So your upside 703.43, which is up 7.3%. And your downside is going to be the put strike, which is 624, less the amount collected. And that is down 6.2%, let's say. Okay. So that's my first question. Let's see. Let's see if you did you respond? Short 20 delta 30 days, aligned to Friday, roll at 3 days to expiration. Or if one side gets to 40 to 50 delta. Okay. So just to put things in perspective for everybody, as you're looking at this strategy, under what scenario does an option get to 50 delta? It gets to 50 delta when it's at the money, right? It'll be at the money on the call side. It'll get to 50 delta unless there's a big dividend or something like that. It's generally going to get to 50 delta just under the call strike because of the forward, right? So we're going to assume that the forward price is higher. And then on the put, it's probably going to be at or just under the strike. So in this particular instance, you would be rolling it if it moved about 7% higher or 7% lower. So that would be one scenario under which you would adjust it. And the other is that you would wait until it had 3 days to go until expiration. Okay. So that's one aspect of establishing, and then you just go through that process. But my immediate question is, did you test it for all such windows? What do I mean by that? Are you looking at every single day's? Imagine that you could have started this strategy today, or you could start it tomorrow, or you could have started it, on last Friday, and so on. In other words, does your sample evaluate all such trades, or does it happen to have begun on some specific day such that you had a really material drawdown? So that's one thing that you need to consider. So when we do testing on, so for example, the Vlad Furman Options Trade AI platform, for example, the solutions that it finds, it looks at all high probability trades, all of them, and looks at the outcomes in their entirety. Like what probability of success and what were the effective returns. And that's a slightly different thing than a back test. It's more of a test of the methodology and the approach. In other words, would it matter which day you started to do this? And if you consider, now you only, for the one that went back 3 years, I'm trying to think, we had the Liberation Day, right? So what would be the days that would have been really, really difficult? And also, how did you deal with this situation, right? So post-Liberation Day, S&P fell sharply. If you were short strangles, almost certainly the market violated your put adjustment rule. In this scenario, when in your back test, did you adjust it intraday? And you almost certainly would have had a violation when the market had that huge turnaround, that rally, where it had a 10% intraday move from the trough to the peak. So, or are you just looking at this on a close-to-close basis? So all of these things would lend some, these are things to think about. For all of you guys, you're sitting there saying, okay, well, I want to backtest a strategy, things that I want to think about. These are the kinds of things that immediately occur to me that I would kind of want to know a little bit more about. That's the first thing. The second thing I would say is, at a high level, why would selling strangles be a good idea or a bad idea over some time frame? So I'm going to go back 3 years, which is what I'll go back. Well, start going back by 10 years first, okay, which is what you did. And the first thing you're going to do is we're going to say, okay, well, we're going to look at the comparison on an absolute basis between the implied volatility of a 1-month option here, 30 days to expiration, and what the market actually ended up realizing. Okay? So here is the thing that you're looking at, right? So in this scenario, you are short the white line you're short at white. So when red suddenly goes, or orange I should say, goes substantially higher, you can end up in a severe money losing scenario, right? And that was the case right here. So in the 10-year period, every single time it was below zero, and let me do an annotation, you're losing money. Every time it's above that, you're theoretically making it if you're delta hedging and you're doing a good job. Okay? So I'm curious if you found that in general, because what you will see is that actually most of the time, you probably should have been making money. Certainly most of the time leading up to the pandemic, you should have been making money. Those periods when you were not, like over here where the little blue box just showed up, that's Volmageddon. Okay, Volmageddon was when an ETN that was short vol blew up. We saw a big spike in volatility in the market. So that was right there, early 2018. Then we have the Liberation Day tariff plunge and then rebound. So if we look at the spread, let's take a look at the spread. So the spread is positive. So if you had been short, if you had been able to be, and this is never realistic, right? So this assumes no friction. This is basically saying if I could sell the average volatility, and the average volatility was 15.4, and the market realized on average 15.3, and I was able, and I had no trading friction at all, then it should have been pretty close to a push. In fact, it's pretty close to a push either way. It looks like volatility was fairly priced. But what I am guessing is that in your backtest, you picked a couple discrete intervals, and as a result of that, what ended up happening was you had these really catastrophic losses right here and right here. That is my guess. And if you invert that, presumably if that was true, and you simply invert the trade, then it's going to look like it would have been better to be long because you would have had windfall profits on those occasions. But actually, in truth, implied volatility and realized volatility over the entirety of the period. So this is each and every trading day. Now, in this particular case, I'm not looking intraday. I'm only looking close to close. But it looks like it was fairly priced. One of the other things that's kind of interesting here is that if you look at this instance back here, Volmageddon was particularly interesting. And one of the reasons it was so interesting was because implied volatility got, and realized volatility also, and for the same reason, were both profoundly low. And you can't really see it on this chart, but you will be able to see it on this one. So right in here, and I remember this because, you know, we were all, you know, we're active market participants. We were sort of watching what was going on, thinking, what is going on? I mean, the implied volatility, options prices had gotten so cheap. It was, you can see right here, implied volatility, 30-day implied for the S&P got to below 7% implied volatility. And realize, look at that, less than 4. And what was going on here? And why was there this huge spike shortly thereafter? What was Volmageddon? So what Volmageddon was, there were some exchange-traded products that sold vol. And they had a really remarkable-looking backtest, and for their life, looked quite good in terms of their performance, just chugging steadily higher. Now, here's the thing. That type of a strategy at a small level doesn't really have a big impact on the market. So if there's a volatility risk premium, and in history there typically was, and you wanted to capitalize on it, a strategy like this would make sense. The thing was, it got very popular. And then you end up having this outsized volatility selling. Everybody's on one side of the boat. Now, that can actually impact not just the price of options, but can actually impact the behavior of stocks too. And you ask, well, how does that happen? Well, the reason it happens is because if volatility buyers are market makers, they're volatility traders, they're going to be hedging. Every single time the market dips a little bit, they're going to be buyers. Every time it rips a little bit, they're going to be sellers. And that activity can actually compress realized volatility as well. So you have options prices dropping, people plow more money in, the volatility risk premium expands, and you can see actually that the volatility risk premium, and that's the difference. When volatility was really low, look how big the volatility risk premium got. So that's kind of what, you know, people don't get that sometimes. They think, oh, I want to sell options premium because volatility is high, implied volatility is high. And that can be true because volatility is a mean reverting process. So you say, well, if something normally trades 20 vol Now it's trading 40. I want to be short at 40. But the truth is that sometimes the broadest volatility risk premiums take place when volatility is very low. And the reason for that is that there is some threshold at which options traders get less enthusiastic about selling premium, which makes some sense because you're thinking, boy, I mean, isn't this volatility has to return to the market at some point? But that difference can get large. And indeed, this is exactly what happened here. So, why did the big volatility spike? That was that strategy coming undone. So the exchange-traded product that was involved with this blew up at this time. And the reason that was so notable for some of us in the options world was that it had only been at the SIBO Risk Management Conference in 2017, I believe, that an acquaintance of mine, actually, a guy named Chris Cole, runs a hedge fund called Artemis, or he did. It was based first in Santa Monica, and then they moved to Austin, Texas. Chris Cole was a former Merrill Lynch investment banker, if memory serves. I've known him for a very long time. Actually met him for the first time when we were all living. I was living in Los Angeles at the time, so was he. He lived in Santa Monica, and I talked to him about his strategy, and he saw what was going on, and he was very, very critical of it. And he actually spoke at the SIBO Risk Management Conference about that exchange-traded product. And he had a picture on the screen behind him. He was on the stage. I remember it so well. And it was that thing, the mythological snake that's eating its own tail. And he was describing this exchange-traded product that way. And the issuers of the exchange-traded product were actually in the audience, and they kind of got into it. So the guy stood up and he was, defending his product, and Chris Cole was basically saying this thing is going to blow up. And of course it did blow up. It blew up before the very next SIBO Risk Management Conference the following year. And Chris, for whatever reason, Christopher Cole did. I don't remember seeing him at the subsequent SIBO Risk Management Conference, where he certainly could have taken a victory lap if he wanted to. But it's not the kind of guy he is. Of course, the exchange-traded product people were nowhere to be seen. But that's one of the things that I think is kind of interesting, is that you can get into that sort of a dynamic. And there are substantial volatility sellers out there. We're substantial volatility sellers, although not in the same way. We don't typically traffic as much in that area. We have a lot of, fundamentally bullish overwriting strategies, and we're not naked short vol the way some of these other things are. We sell call spreads, typically against long equity positions, or put spreads against short positions, that sort of thing. So we typically have spreads on, which has a very different dynamic, as you would expect, than just being naked short volatility and compressing it the way they did back then. But I'm guessing that as part of your backtest, you kind of need to work through all of these things. So you want to look at implied versus realized. That's one of the first things you want to take a look at. The second thing is your rules. Is it for all such strategies between the start and the end date? Which I realize is a lot more work. I'm not going to deny that. It's one thing to say, I'm going to have a strategy where I just get long certain stocks that I like and I rebalance it every 3 months and I go through it. That's not a very challenging backtest to do. If you have something that you say, okay, I'm going to be agnostic to when this thing actually ran, or you could say I'm going to sample it on a certain cadence that, let's say you were looking at regular way expiration to regular way expiration. That's approximately 30 days. And then you said, okay, well, I want to do a more robust test, so I have to take my rule set, but apply it out of sample, which means that you're going to have to jog it in some way in terms of the timing. So those are all really important things to do if you are going to be backtesting. But it's a very worthwhile exercise, but those are some of the considerations I would give you. I hope that's helpful. And yeah, so hedging the delta. So in this particular case, what we saw is, whether you were hedging the delta or not, I'm going to have to actually look at the break points on an unhedged position to see. Now, what's also interesting is, and this is the work that I've referred to a couple times before, Bruno Dupire, who's the head quant at Bloomberg, he's done a lot of very interesting work on volatility. His suggestion would be, or at least his research has shown, that it probably makes some sense to behave as if you are long gamma from one day to the next and then true up periodically. So this has to sort of do with the sort of the continuity of vol and things like that. So you might want to just check on that idea. But my guess is that if you're hedging your deltas each and every day, as this showed, and no matter what day you chose, so this is like this is the full sample because it's rolling implied versus rolling realized. Yeah, selling vol consistently over the last 10 years and hedging it dynamically would not have been a huge moneymaker. All right. Okay. Hi, Mike. There is now talk about a Fed hike. Where do you stand on it? Thanks. Well, I think what's going on in the Middle East is going to play into this quite heavily. So here's the story. There's no getting around this. Crude is a really important component of the inflation story. I've heard different people allude to how much of the global economy flows through that strait, and the number is, shown as being something like 50 to 100 basis points of global GDP. And as I was joking with somebody over the weekend, it's not funny, but what I was saying is what percentage it represents depends a lot on how expensive crude is, because almost everything depends on it. Look around you right now. How much of what you see is not impacted by oil prices? And I'm gonna say that you probably can't find anything. You probably cannot look around you and say the price of that item is unimpacted. The fact that you're actually, even looking at me right now depends. Energy costs, including fossil fuel, impacts even things like electricity costs. So it's in everything. And the higher it goes, the bigger a percentage of the global GDP it is. So really high crude prices are a really big problem. And it is inflationary. There is no getting around that. So if they do not get that under control, there would be no reason to cut rates that I can see. And that's a pretty bitter pill to swallow also for governments, because you're going to have higher interest rate expense. If the economy is slowing down, it's just a perfect storm. We really don't want to see this thing carry on too long. It is not good. Actually, I was looking at this before, so let me do my little vessel map. I think I showed you guys this before. And I did see some tankers transiting the strait. Many of these things are at anchor. But let's take a look. We're just going to go in here. This is all ships. I'm going to clean this up a little bit because this is, frankly, just a little bit too much to look at. I recognize that. So too many ships right now. So I'm just going to shift the type that we're dealing with here. I only want tankers for now. Let's just look at those. And I did see that there were some ships transiting the strait, which I was reassured about. So where you see an arrow, I'm going to blow this up. So maybe you guys, I don't know if you can see it really well. I'm going to make this as big as I can so you really know what I'm talking about here. When you see an arrow, that is a tanker that is underway. Otherwise, it is not, right? So this one here should be anchored. See? I don't know if you can make that out. But see if I can blow that up even more. Does that blow that up? There we go. So as you can see, this ship is anchored. This one is underway. Oh, no, that's anchored too. Did I hit an arrow? Oh, no, that one's, why is that anchored? These two ones should be underway, usually. I saw a bunch underway in here. This one's underway, under power, and look where it's headed. Carg Island. That's obviously been in the news quite a bit. And the beneficial owner is NITC. So some of the ships that I was seeing, there was a Chinese ship or two. This one is underway. This is a products tanker, so we're talking about what are the products? You know, you're looking at kerosene, jet, diesel, naphtha, gasoline. How about this one? This one's underway. But notice something here, and this is, you know, when I was looking earlier today, this is what I was really hoping I wasn't going to see. So the beneficial owner in this case, Iran shipping lines. So I think we can assume that they're probably not going to attack their own ships. What we got here? So, yeah, this one is anchored. So many of these things are still not moving. What we want to see is we want to see a lot more of these arrows flowing through here. But I just have a hard time seeing how we're going to get to any kind of a rate cut if this is what we're dealing with. I just don't see that, frankly. So, you know, I think the dot plot isn't all that revealing at the moment. It looks like there's kind of an even mix. We had some dovish, some hawkish, some very hawkish, and then most of the people were just in the middle. But the best thing I would say, if you're really interested in what's going to happen, is look at the 2-year. I think that's kind of just going to be your judge. Today, you can see that it came in a little bit, and that's not surprising because the futures shot up and crude came in. So these things should probably be tracking together, crude and the 2-year, and actually, they kind of have been, right? It's not going to be on the same scale, but let's see. Hopefully, just get a sense of what's happening here. So you can see that as crude rallied, so too did the 2-year, because as crude rallies, so too does our expectations about inflation. As inflation expectations rise, short-term rates will rise, and so on. But I don't see a huge reason for aggressive cuts at the moment. And then the PPI data was a little hot also, right? So even before all of this. By the way, for those of you who are wondering why, I just noticed it when I looked at a picture of myself. I have this thing on. My wife has asked me to wear this. Apparently there's some kind of a health ring called a Oura ring, O-U-R-A, I'm not sure. Anyway, I think she's getting one for herself. She wanted to get one for me. But in order to do that, they need to have a sizing thing, and you're supposed to wear this around for a little while. So all this is a little plastic ring, like a shower curtain ring sold by John Candy in Planes, Trains, and Automobiles. Anyway, I'm supposed to wear this to get a sense for what size ring I would wear. I'm starting to wonder, though, whether I could even stand it, because this thing's in Galleon. Yes, Tucker D. Dog, thank you. That was Raj Rajaratnam's hedge fund. All I can remember is that there was a recording of one of his phone calls with one of the analysts that was giving him tips, and he was saying, "Let's go, baby," or something like that. Anyway. Okay, so yeah, I mean, I don't see any reason to cut rates, and if this keeps going, then yeah, there would be a reason. Monday morning quarterback, I was short. Oh God, you were short the E-mini futures when it spiked. Reached a bunch of alerts before all my stops got hit. I'm sorry, man. That's not good. But I will look. I mean, I'm very curious. You know, let us know what kind of alerts you were getting, because this is exactly the kind of thing that I think it's really important to keep an eye on these types of things. And you know, when something really unusual happens, you know, that shouldn't, you know, kind of like the Duke brothers in the movie Trading Places. You know, that's not right. How could the price be going down? That was the line from the movie. When you see something and you're thinking, that's not right. Why would that happen? You know, that's not right. Why did the futures just spike on a 4,000 lot? Who even trades a 4,000 lot at 10 to 7 in the morning. And then there's a lot of carry-on volume. What's going on there? I think maybe somebody can research this and you can populate it here. But Stanley Druckenmiller made a point, and I think I read this. It was like a quote of his a week ago where he said that one thing that Wall Street analysts don't get is that, whatever they happen to think fundamentally about a stock, if the stock keeps going down, something's wrong. And I'm probably butchering his quote or whatever it was he was saying, but basically the idea is that the market can sometimes alert you before the information is out that there's something about your thesis that is off. And here's the reason why that might be true. And that is that when you look for unusual volume, somebody who really knows something, that has real insight, those are the people that are willing to commit substantial amounts of capital, sometimes, in the face of a lot of contravening evidence. And so that's going to happen. It's not, the way you can kind of look at, if you look at the market, that's just that's the wisdom of all people. It's the wisdom of crowds. That's like, people will say price is truth. And I get that. But when you see a really large and unusual trade, somebody that's willing to buy, 4,000 or 5,000 futures contracts, when the market's not that liquid, in the pre-market like that, and is willing to pay up by not in a small amount, the thing you ought to ask yourself is, why would they do that? Do they know something? That person is more likely to have an insight than the average bear. And in fact, when it comes to outside of regular market hours, this is more true. In fact, I think I told this story once before. It had to do with Tyco. But we actually, as a trading firm, we decided that we were not going to trade in the pre-market. And the reason we weren't going to do that, when we saw big blocks coming in, and even if we had a lot of stock to trade, we had a situation I was long a lot of Gamma. Tyco had some very negative news come out before the open. I can still remember looking at the Instinet machine. That used to be a dedicated machine, green CRT display, still traded in eighths or whatever. It was trading 36.5, 36 3/8, something like that in the pre-market. I looked this way, I looked that way, I looked down at my screen. It's now 8:05 in the morning, and it's trading 30. It's trading 29. I'm like, whoa, what is going on here? I was short a ton of stock because I had all this Gamma, so I had stock to buy. And we ended up buying some, and then we decided we weren't going to, and then my boss was over in another booth, and he was picking up a bunch of it, and we ended up buying, some stupid amount of the stock before the open, and in 10 and 20,000 share blocks. And, we watched that thing trade down to 22 before it opened. And our first buy was around 30. So we were buying it at 30. We were buying it at 29. We were buying it at 28. Thing traded all the way to 22 in the pre-market on size. Big blocks of stock, okay? And then I remember it opened on the big board at 26. And you can tell that these kinds of things really stick in your craw, stick in your memory, because that was in the 90s, what I'm referring to right now. It was like 99 or 2000, something like that. But I remember where the prices were, and I remember the blocks of stock. I can just still see the tiles going up. And after that day, we said, you know what? If you don't know why people are trading it in huge size, you don't trade the other side of it. You want to go along with it, that's one thing. But if you see people doing something that no reasonable person would do before the open, they probably know something you don't. So, I speak from personal experience on this kind of stuff for what it's worth. So Monday morning quarterback, hopefully I'm glad you had stops in. Hopefully, the thing is, that was such a sharp gap though. I'm hoping that your stops got triggered before we had that huge gap. I don't know, but anyway. Finwest, so that wasn't your trades from your petty cash account. No, certainly not. Certainly not. I mean, look, we do some pretty big trades. Not me personally, but our trading desk is, we do a lot of options. Probably 5 to 8% of all the U.S. listed single stock options volume in a given week. Probably. That's so chunky. We do a lot of it, but that's not going to be us. We're not punting it around in the futures in the pre-market. That's not what we do. We run investment funds, not speculative trading bets that are going off of Truth Social posts and stuff like that. We're not on the inside in DC. Monday Morning Quarterback says, since I'm in Orinda, you was asleep. That's interesting. Well, just so you know, I mean, I'm going to wrap this up pretty quickly because it's over an hour now. But we would typically have our morning trading calls, even when I was on the West Coast, 7:25 East Coast time was when those calls would begin. So we're talking about 4:25 in the morning. That actually would have missed that particular trade as it happens. But my suggestion is, the covered caller says, hello from Austin. You're not... Oh, and somebody else says that Aura ring is good. Lots of good data for you. Interesting. Okay. Well, we'll see. Yeah. I guess that's... Since we started that way, we'll end this way. I don't spend a whole lot of time monitoring the tape. That's not the way I've been a trader, because mostly I've either done stat vol arb or investing. Those are two different realms, and neither really depends on that. But I will tell you this, in the pre-market or after the close, if you start seeing some unusual activity on volume, so unusual volume, unusual price taking place in the after hours, look at your positions carefully, because in my experience at least, people don't typically do that unless they have a real reason to. So, and actually the nice thing about it is that is when those volumes are going to stick out more, because you don't need to monitor your whole universe of single stocks at 7:30 in the morning. But you can keep your eye on the futures. And if you start seeing big prints like this, and that was an easy one, 4,000 lot, futures ticked up a substantial amount, couple thousand contracts trading crude at almost exactly the same time, and that dips at that moment. So you can easily see that there was an unusual trade. You can easily see that the S&P futures were bought. You can easily see that the crude futures were sold. And if you happen to be keeping an eye on both, because that's the big trade right now, I will tell you that starting today, those are going to be the two futures I'm keeping: the front month crude contract, the front month E-mini contract. When the market's not open, those are the two things I'm just going to have on a separate screen, just ticking away. Don't know if there's going to be another unusual trade to take advantage of, but that's my tip of the day. Watch the futures. Want to know the future? Maybe you watch the futures. With that, until Wednesday, have a good one. Thanks for watching. Sorry again about last Wednesday. And we'll check in with Mark Guthner hopefully tomorrow for office hours. Thanks for watching.